Chances are, with you watching this video, you're in some way looking at real estate. Whether you're looking at buying right now, or maybe you're just curious about the ways of the market, one thing that is super apparent right now that cannot be avoided when talking about real estate is the high interest rates we're dealing with on mortgages. With the average 30-year fixed rate sitting right around the 8% level, it's hard to avoid, and it's becoming harder and harder for the everyday American to go out there and afford a regular single family house. So in today's video, I'm going to be going over 3 different ways that you could potentially get into a house with a lower rate than that 8% mortgage. And if you stay tuned to the end, I'm actually going to throw in a bonus that some of you might hate, but some of you might really enjoy hearing because it's the cold hard truth and just needs to be put out there a little bit more. So let's dive right on in. So this is going to be the most commonly heard way of lowering an interest rate, and that is with a rate buy down. A rate buy down is when you purchase discount points, or what they call prepaid interest points at closing. It's a one-time fee, and it's going to lower the interest rate for the life of the loan. Now, this is one that does go for the life of the loan, and there's another one which is actually the same thing. It's a rate buy down, but it's when you actually buy it down for only a certain amount of time. So a big one that is like really popular right now is called a 2-1 buy down, and you might have heard of it. So what this is you get a mortgage. Say you get a mortgage for an 8% interest rate over 30 years, right? So just a normal 8% 30-year mortgage. And what the 2-1 buy down does is it affects the interest rate for the first 2 years of the loan. So in the first year of the loan, you're going to be 2% lower than the 8% that you have for the loan. So that first full 12 months, you'll be at a 6% interest rate. After that 12 months, now you're at the 1 of the 2-1 buy down. So you're 1% lower than the regular interest rate of the loan. So instead of 8%, now you're at 7% for another 12 months. After that second 12 months is done, so after 24 months, you're 2 years in, now you're sitting at that 8% interest rate for the remaining, 28 years. So that's how a 2-1 buy down works. A lot of times right now, you're gonna see it in the market, and most of the time, the seller is actually going to be the one paying for it in the aspect of closing costs and concessions towards the buyer, because a lot of times for the buyer to do this, it just doesn't make any sense, because like say in that first 2 years, you're saving $8,000 worth of interest payments, but you'd have to put $8,000 up essentially at the closing table. So it doesn't make a ton of sense. And another thing to understand just with buy downs in general is they're usually seen as a longer term play because they are expensive. Like a lot of times the bank will kind of tell you, don't really even worry about a rate buy down or look into it unless you're going to be staying in the property for 5+ years, because that's usually where you actually see the break even point of making that money back and saving it in the interest, so that you're actually now kind of in the green, as you would say. So it's definitely a longer term play, and it can get pretty pricey. I actually did this with the house I'm currently in. I bought it down 0.25%. And my main justification for this wasn't because it was saving me a ton of money over the life of the loan. I was just told that it was going to be a certain rate. And literally the day I got accepted on this property, the rate went up. So I got a little frustrated and bought down the rate just so my numbers would work as I ran them when I went to put in the offer. That was a little bit on me, a little bit of miscommunication with the bank. We figured it out. It wasn't that big of a deal, but again, it's going to be seen as a longer term play. I'm sure a lot of you guys have heard about seller financing and have been told that this is the go-to way to go get a good interest rate. And I'm going to keep it real with you. It's a great way to get a good interest rate if you find the right seller. But the hard part is finding the right seller. These deals do not come up every day, and they can be tough to actually get down on paper and make a deal work out. But what seller financing is, in case you don't know, is just as it sounds. It's when the seller is actually willing to finance the property for you as the buyer. So in most cases, the property has to be paid off. Now this can be done without having a paid off property, but there are risks involved in that tactic, and that's for a whole different video. So when I'm talking about seller financing in this specific video, I'm speaking from the case that The property would be paid off and the seller just wants to act as the bank and give you the note and hold the note. Now, how this works is a little bit different with seller financing because you can get a good interest rate. And the good thing about seller financing is it's really between you as the buyer and the seller. And you guys get to make up really all the terms you want. You get to agree on the purchase price, the interest rate, the length of the loan, how frequent you actually pay it. You can kind of make all this customizable. But the one thing you want to keep in mind and be super aware of when working with seller financing is that the seller is typically going to want some type of balloon payment. So they might not want that super high interest rate, and you can find a way to get it in low. Maybe you get a 5 or 6% interest rate with this, which could be great right now. But just keep in mind that there's going to be a balloon payment that wants to be built in, because if you're the seller, chances are you're kind of on the older side if you have a paid off house that you're looking to get rid of. So they don't have the whole time to wait 30 years to get paid for this. Now, a lot of times the actual mortgage payments will be out 30 years, but the balloon payment's usually within 5, meaning that after 5 years of making those payments, on that 5th year, you're gonna have to owe a balloon payment, which is the remaining balance that's left on the loan, and you have to pay the seller off. Now, you can either do this by refinancing and getting a regular loan through a regular bank. Hopefully within 5 years, rates will come down and that'll be justifiable. Or you have just a lot of money saved up, but then it wouldn't make any sense to go through seller financing. And the last one would, if you're completely out of options and you can't go refinance, can't do this, you would just have to sell the property and pay the seller off so that he makes his money. So there are some things to be aware of here, but it can be a super powerful tactic if you find the right seller. And again, it is hard to find. If at any point in this video you found some valuable information or learned something new, I'd really appreciate it if you hit that like and subscribe button, as it really helps the channel grow. And if you have any questions about this video, make sure to drop them down in the comments. So next we have assumable mortgages. And these you've kind of been hearing a little bit more and more about ever since I noticed like 6.5% interest rate and above is when I started hearing more and more about assumable mortgages. And these are kind of like seller financing in the fact that they can be tough to find. It really has to work out, and the seller actually has to offer it, of course, because what is happening is you as the buyer, you're assuming the seller's mortgage. So you're going to be assuming the mortgage with the interest rate, the monthly payment as it is, and the remaining balance. So you're going to take it all and assume it from the seller. Now, keep in mind that you're going to actually still have to go through the whole pre-approval system to make sure you're actually approved for the loan. So you're going to have to run through that with that lender. You don't really get to shop around lenders. And you have to think that you're going to have to make up a big chunk of money somehow, some way. Because say with this scenario, you're buying, let's just say a $350,000 house, and the seller is offering an assumable mortgage of $200,000, but you're going to get it at an awesome 2.9% interest rate, and that's the main reason you want to do it. But that's only $200,000. You still have another 150 grand that you have to come up with to actually make this deal work. So you're either going to have 150 grand sitting on the sideline, or find a way to get another mortgage or another loan of some type to actually be able to make this deal work. But keep in mind that when you go to get this $150,000 difference in a loan, you're going to be at the current rate. So you might get stuck with an 8% there. It might even be higher because it's not a regular first position mortgage. So I haven't personally done one of these with a client yet because it just hasn't come up in my job at this time. I hope it does so I can have the experience, but that's just one thing to like keep in mind is how you're going to make up that difference. Yes, it's awesome getting a 2.9% interest rate, but what are you going to do for that other $150,000 that isn't included on that mortgage? So that's just something to keep in mind with that. It is an awesome thing, and it also depends on the actual loan that the seller has. So not every seller can offer this. Just keep that in mind. The loan that they have actually has to be an assumable mortgage. So it's not up to the seller. You can't just go up to like any seller on the MLS and be like, hey, let me assume your mortgage. It actually has to be a certain one, and the bank has to allow it. It's not like the seller's the one that gives the okay or not. Just keep that in mind. Now, if you're still watching the video, you are the one that actually gets to hear about the bonus. And like I said in the intro, a lot of you might hate my answer to this and actually hate hearing it, but it's a good thing to hear and needs to be told a little bit more because it's a cold hard truth and sometimes people need to hear that. And it is super simple. You might just want to wait till you're in a better financial position. It's that simple. If you're in a bad financial position and you're really trying to make it work so that you can afford a house, right now in today's market might not be the best time because it's hard enough if you're in a good financial position right now to actually get a house and get an affordable house right now. It's hard enough when you have good credit and good down payment. And if you're working from the matter of having none of that and you barely have enough savings to get through and actually purchase the house, your credit's crap, you're not going to get the best rate. So take some time, learn about financial literacy, take this time to actually improve your credit score, because when you go to purchase the house down the road, you're automatically going to get a better credit or a better interest rate because your credit score is better. So you're seen as a better borrower. So that you can do, you can go save more money and actually become better with your finances through that, so that either you have options where you can put more of a down payment down when you go to purchase a house, or you put your down payment, but now that you actually have the savings, you can actually have that rainy day fund sitting in the back just in case something comes up once you do buy the house. And it's just really good to actually get in the right position, because a lot of people try to force home ownership, but then once they actually get the house, their house broke and they can't go do anything fun, and they're worried about stuff breaking because they don't have those extra funds sitting ready to go. So just make sure you don't get in a cruddy position where you become house broke and then you kind of regret buying a house in the first place. So that wraps up this video, and that's everything I had about how you could potentially get a lower mortgage rate than that high 8% that's being offered right now. But if none of these options work out for you and you just have to go buy a house like a lot of people are doing right now, and you do get stuck with that high interest rate, just understand that once these rates do come down, you'll be able to actually refinance and get into a lower rate. Now, of course, you're probably asking, well, when are the rates going to come down? That, I wish I could tell you, but I don't have a crystal ball to be able to tell you that. But the one thing I do want to say confidently, and a lot of other real estate professionals are speaking on right now, is that people are scared to buy right now. But just understand, even if you do get stuck with that high interest rate, which is going to be a tough one to deal with, but just understand, once those rates come down, those home prices are going to shoot right up, because our biggest issue right now is lack of inventory. Yes, high interest rates are affecting the market, but not as much as the actual lack of inventory that we have. That's why this is presenting such a big problem. So once rates come down, prices are going to shoot up, because everyone that is sitting on the sideline and not wanting to buy because they don't want an 8% interest rate, well, when the rates come down, they're going to come out gung-ho and swinging and shooting up all the offers, and probably going to be the same monthly payment as if they just got a 8% interest rate in today's market, because the prices are going to go up so much when they actually go to purchase. So that's all I got to say on the matter. I hope this added some value and maybe taught you something new. If it did, make sure to hit the like and subscribe button, as I do come out with weekly videos, and I will catch you guys next week.